Welcome to our live recording of Merryn Talks Money, or Merryn Talks Budget, as it is this morning. And thank you all very, very much for coming this morning at this early hour. I am just here literally to give the introductory remarks, but I do have two very important jobs first, which is to get you to subscribe, if you haven't already, to the podcast, to Merryn Talks Money. And several of you I see are nodding knowledgeably, so you don't need to do that. But if you do need to do it with your phones now, because it is great, where Merryn, John Stepek, and guests, as they will today, chat money, chat macroeconomics. It's a great listen. And the other thing is to offer you a freebie, because on the other side, on that QR code, is 3 months free subscription to Bloomberg, which some of you may have already subscribed. There's even a special budget special offer going on at the moment, actually, for quite a good deal for the year. But if you don't want to do that, 115, this gives you 3 months free. Now, I happen to know we have the stats. Quite often, a lot of you nod and, yeah, I'll do that once it's finished. But you're so transfixed by Merryn, Stephanie, John, that you forget later. So I'm going to give you, hold up your phones now if you haven't got Bloomberg.com. And if I'm in the way, am I in the way? Write in your email. Takes a bit of time. I'm trying to give you a few seconds. I'm just talking while you do it. Write in your email, and hopefully you'll get it. And if you don't, and there's some problem with it, from your registration, you've probably got some way, I think, of... I'm Victoria Wakely. I'm the UK editor at Bloomberg News, so you can maybe track me down and complain about why the subscription's not working, but it should be. And I'm hoping there are so many fantastic things on there. Phil Aldrich today on the budget, a great graphic on what the macro picture of the budget looks like, brilliant analysis of Bloomberg economics. You'll be so transfixed after 3 months, you'll definitely want to continue. But anyway, that's my main job today. You've hopefully all turned your phones off, because this is going to be a live recording. And Merryn will be on stage shortly. Just one other thing to say, if she doesn't get the chance, she's shortly also going to be launching a new newsletter for Bloomberg. So that's an extra reason for you all to have to subscribe to read it, because that's the future, subscribing to read newsletters. Anyway, without further ado, please welcome onto the stage now your host, Merryn Somerset Webb, just making sure you're awake, and friends.
Morning, everybody. Thank you for coming. Hugely appreciated, and thank you, Vic, for that introduction. Right, I think we'll get straight on with it. Just to let you know, we will have time for questions at the end. So if you have questions along the way, just bear them in mind, and we'll get to them, and there'll be lots of that. But as Vic says, this is a podcast recording, so I'm going to go straight in with the podcast introduction, because there'll be lots of people listening who aren't here today. So here we go. Welcome to this special edition of Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. We are recording this episode today in front of an audience. Hello, audience. Welcome. At our Bloomberg headquarters in London. And we're doing that because it's a special day, depending on how you define special. It is the day after the long-awaited budget, which I'm sure you all watched very carefully yesterday. So before we get on to introducing the guests, let me just take the mood of the room. Who felt better after the budget yesterday? Okay, so that's quite a lot of hands. A lot of people felt better. Who felt worse? Okay, and of those of you who put your hand up and said you felt better, did you feel better because it wasn't quite as bad as you expected? Yeah, that's all the hands. And did anybody feel better because it was really, really great? Okay, for those of you who aren't in the room, not a single hand went up. So there is obviously quite a lot to unpack here. We're going to unpack those announcements. We're going to look at the tax hikes, look at the extra borrowing, and look at the smaller measures and what they actually mean for you. Right, onwards. I'm very lucky today. I don't just have money distilled author and Bloomberg writer John Stepek. Obviously, we have him most times. This is fantastic. But today we are extra lucky. We also have Stephanie Flanders, head of economics and government at Bloomberg News and head of Bloomberg Economics. And as an extra treat, we have Andy King, who spent 10 years at the UK's Office for Budget Responsibility, most notably as a member of the OBR's Executive Budget Responsibility Committee, and who is currently a specialist partner at Flint Global. So welcome, all of you. Thank you. Andy, could I possibly start with you? As we saw from the show of hands here, we've got an audience that wasn't madly impressed. And when you look at the bare numbers, what you see is a massive tax rise, very significantly larger than anyone would have expected if they'd listened to any Labour politicians speaking before the election, much more than you might have expected if you'd believed the manifesto. A very sharp rise in spending, both investment and current. A tax to GDP ratio that is going to be one of the highest ever, a state spending ratio that is possibly one of the highest we've ever seen. And when you look out over the rest of the decade, really quite shockingly low growth numbers. We get to 2% next year on the forecast, but beyond that, we're well below 2% into the end of the decade, and we average out the decade at 1.58%. And that's not GDP per head, it's just GDP. So if you look at those bare numbers, it's hard to feel good about it. On a big sweep, is there anything that you can see there that makes you feel a little better?
Well,
this is the tone I'm planning to use the whole way through, by the way.
a very leading introduction. Thanks very much. No, I mean, I thought the show of hands really told the story there. What was it? 60% unhappy, 40% could have been worse.
Yeah.
And that's probably a decent outcome for this budget, because the Chancellor's inheritance was a tax burden set to rise to the highest in decades, was a larger state than before the pandemic, but was a state that the plans were to cut that back quite substantially without any detail on how that would be done. Now, my former colleagues at the OBR, who were not allowed to make normative statements, did their very best to say that that was implausible, perhaps even impossible. And so what we saw yesterday was a replacement of essentially unrealistic numbers with at least possibly deliverable realistic numbers. And the difference was huge, as you say, £70 billion going into public spending, most of that, 2/3 of that into public services, 1/3 into public investment, a huge tax rise, adding to what was already a huge tax rise baked in that had been announced in the budget since the pandemic. And strangely, it leaves the size of the state in 5 years' time roughly where it is today. It's a decision not to reduce the size as opposed to increase it. Of course, it is much larger than it was pre-pandemic. That's down to things like aging, down to things like the health troubles in the country, and the very important point at the end, it's because growth is weak and has been weak now for 15 years and is essentially expected to remain weak for another 5. And there are those who would say that the OBR is a bit optimistic, not pessimistic about growth, but it's still a very challenging outlook. And I think that was my takeaway. You needed to do all of those things to get the public finances and public services on a path that can be delivered, but is still quite difficult.
Yeah, and is incredibly fragile, the whole thing. So it's incredibly vulnerable to shifts in inflation, and we may see higher inflation as a result of this budget, incredibly vulnerable to shifts in interest rates, and the positive part of this budget is very far out. The idea that as a result of this kind of spending over the next 5 years, we'll see an uptick in GDP over the much longer term. I mean, this is fragile stuff, right?
It is. And, there are parts of this budget that unfortunately look like those from pre-election. So fuel duty has once again been frozen only for 1 year for the 14th time. And, the fiscal targets have been changed. One is actually tighter and one is looser than those that were inherited. But there's only a tiny fraction of headroom against them. So any of those things you mentioned, or any decisions that are taken, defense spending, say, they all will require either trade-offs or will make life difficult because the outlook is challenging.
Yeah. I mean, there is no getting away from the fact that we've seen extraordinary changes in the role of the state and in the amount of debt we have in the UK over the last couple of decades. So if you go back to before the financial crisis, our debt to GDP ratio, correct me if I'm wrong here, Stephanie, because you're the expert here, was around 30. It was about 30, I think, 30% or so. 80 before COVID. Now we're up at 100, and there's no, as I think any of us can see, sort of credible reason to expect it to fall significantly from there. Back in the 1990s, the state spending was what, around 28, 30% of GDP, and now we're up into the high 40s. You know, we've made some fairly extraordinary shifts. And when you look at a budget like this, can you see any way that we row back from those rather extraordinary numbers?
If you make a substantial change in the way you think about public services and the quality of and the degree of generosity or adequacy of the welfare system, then you could take us back to those levels. I think it's a little bit odd to focus on this budget in isolation and focus on that debt number in isolation. You know, the budget comes, as Andy has said, the budget came at the beginning of a parliament when I imagine nobody was expecting it to be a big giveaway budget. It never is. And when it had been very widely flagged that there was a complete disconnect between sort of the realistic spending plans and the level of taxes that people had committed to on either side. And I think actually the polls suggest that everyone did in fact expect the Labour government to raise taxes more than was indicated in the manifesto, and that would also be the case for the Conservatives if they'd won, I think. So I think it has to be placed in the context of where we are, what the plans were like before, and I think the very tough challenges. I mean, Andy's right. I mean, for me, this just told us how much you have to do just to begin to narrow the gap between what we want as a nation in terms of our welfare services and our public services and how much we're willing to pay for it. And it's a very common thing that people talk about the gap. But, you know, that is why we're going up. It is a all-time high, even slightly higher tax ratio than it would have been under the previous government's plans. Or you could say we're moving towards the European average because we actually want European-style public services, and that's a choice. But I think it sort of shows you can do all of this. You can spend another 70 billion, of which 40 billion came from higher taxes, and still only be sort of, as Andy said, sort of paying for what you need right now at the most basic level. The other thing you look at in isolation is the rise in debt, and I think to look at what's happened to our growth and what's happened to our debt as a country without looking at the global context and what's happened to the debt of every single advanced economy. I mean, Germany, I think, truly is the exception in not having seen a more than doubling of its. I think it's even Germany has seen a doubling of its debt, but it's still relatively low. Every other country has seen a move either beyond 100% of GDP or close to 100% of GDP. As we know, the US debt trajectory is even more unsustainable, but with a stronger growth underpinning it. So this is not to say that everyone else is terrible, so we get to be terrible too. But I think that our country has responded to similar challenges and has sort of had to run up debt in response to that. Whether we can, I think that you're right to highlight the weak growth picture, but it is over the piece no weaker than it was looking before and has been since the global financial crisis. It is fundamental to the narrowness of the choices we face that we are not be able to get that productivity growth rate, long-term productivity growth rate back anywhere close to where it was before the global financial crisis. But I mean, that too is a shared challenge. And I think at least we have a very clear effort to invest over the next 5 to 10 years in an effort to try and move the dial on that. And I would say I think the Office of Budget Responsibility is optimistic in some areas because it's been proved wrong on its productivity forecast for a very long time. Where it was quite negative, I think, was on the impact of public investment on private investment and on the broader capacity of the economy. As they say themselves, there's perfectly possible that public investment will crowd in private investment. They're assuming it won't, and they're assuming, in fact, it's a one-for-one trade-off. The US, it was learned that you could make room through those kind of investments. We'll see.
Yeah, we'll see. So if it had to be done, best done quickly, and was employer national insurance the right way to do it? Do you think? I mean, that puts quite a burden on businesses, and if you add up employer national insurance rises and you add that to the rise in the minimum wage, you've got a lot of smaller businesses and businesses in the services sector screaming slightly.
You have chosen to put quite a lot of pain on, I think, medium-sized, the very small employers. I think they've made an effort to at least partially protect them. Yeah. But I think you're quite right that the combination of the national living wage increase and the national insurance rise is a sort of upfront challenge, and an increase in the cost of labour. I wouldn't have cut national insurance in the last year, and I think there was no economist who thought that was affordable, especially by taking 20 billion out of the future public spending plans. That's what happened last November. Is the way a large part of how, I'm hesitant to say this with Andy King because I know he will immediately correct me if I'm wrong, but a large part of how the national insurance cuts were quote unquote financed was through these very unrealistic spending plans. So in a sense, Rachel Reeves was just reversing cuts which were widely felt to be unaffordable. I think it's unfortunate that the reversal has been is as bad for, or is affecting labour supply in a negative way and hurting employers, when you probably would have wanted to just add a few pence to income tax, but that's not the world we live in.
Now this rise in NI, we should mention it. You speak about employers and employee NI in the same kind of breath, right? As though they're sort of the same thing.
So does the Office for Budget Responsibility.
So does the Office of Budget Responsibility, exactly. But Rachel Reeves does not. So we must assume, mustn't we, Andy, that this does end up coming through at lower wages, or certainly lower raises to wages.
Absolutely, and so the OBR said that yesterday. They expect in the end 3/4 of that tax rise will ultimately manifest itself in lower real wages, probably over time, as next year's 4% pay rise will actually be 2.5%, and those kind of decisions. They do think that 1/4 of it will come off profits. The way in which the tax rise was structured, with actually most of the revenue coming from moving the point at which each employee's wages start to be liable for NI back to £5,000, means that the tax rise itself is quite concentrated on low-paid people. It doesn't matter whether you're a large employer of low-paid people or a smaller employer of low-paid people. It's low-paid people where the tax rise is largest, but also that is the same group where your room for manoeuvre is reduced by the living wage. So you can't actually choose how much a pay rise you give. So that looks quite risky to me.
Well, maybe it's just a way of trying to boost productivity. Make it very expensive to hire people down at the bottom end. You force people to introduce productivity enhancement measures.
That has always been one of the arguments for why minimum wages could work. That although in someone's model it says you can't have a latent productivity gain that a business has not already taken advantage of, in the real world you can.
You can. It's different.
And just on that though, I mean, ever since the minimum wage was introduced by Gordon Brown, this has been the fear. And it's been gradually increased. And there was always a feeling that at some point it would start to really hit employment. But up until now, and that's actually been surprisingly positive for both employment and living standards at the bottom end. So who knows whether we've reached that critical point. I mean, it is now getting closer to the average earnings than you would have ever thought was possible without having a big impact on employment. But a lot of the studies I was looking at one in Manchester and other places, it has actually raised productivity in these low wage sectors in a way that you might want to see, and hopefully that will continue.
Yeah, actually, one thing I'm curious about on that point, Stephanie, is, I mean, presumably it has to have had an impact on, for example, wage compression. The gaps between. So if you're a minimum wage earner, then the person above you and the person above you, the gap between those wages gets smaller. And therefore the reward for, if you like, taking on more responsibility or going for promotion also becomes smaller. Is there any kind of evidence of that? Or, I mean, the other thing is also, the choice between working as, say, a low-paid position in the NHS and working on the tills at Tesco. One of those jobs, I think most people would agree, is much harder than the other. But if the gap between the pay for them is non-existent, then that's why it's perhaps harder to recruit for certain roles than others.
I mean, that speaks to there's much broader question about whether or not, for example, in social care, whether there's enough money going into that system to have people be paid in a way that reflects the hardness of the job. So I think that's sort of the mixing it together. But you're absolutely right that it does cause compression, but it isn't the case that everyone just gets pushed. I mean, and that means that you're not paying more to everybody in order to preserve those differentials, which, depending on how you look at it, it certainly is a good thing for people at the bottom.
Yeah, aye.
And employment is a good thing for employment because you're not having to pay more for everybody, you're just paying more for those people.
John, you wrote a Money Distilled last week, or actually early this week, there were several criteria for whether this would be a good budget or a bad budget. How'd it go?
I mean, well, it didn't crash the gilts market, so that was the first one. I did feel at the time that was a pretty low hurdle to clear because, you know, generally budgets don't crash the gilts market. That doesn't happen that often. In terms of making the tax system less complicated, it's hard to give her a tick for that one. You sort of introduced new levels of inheritance tax, for example, without really reforming it particularly.
In fact, we should have a little poll on that. Did anyone in the audience move their pension from DB to DC in order for their children to be able to inherit it? No, I mean, I think we do have quite a few listeners who did do that. It was a disappointing day for them yesterday.
Well, that's a good point. I mean, one thing on the inheritance tax thing, I mean, I don't know, but I remember when that first happened and it became clear that you could use a defined contribution pension to stash away your assets from inheritance tax. I realise this may or may not be a popular thing to say, but I remember when we first realised that and we were writing about it, we were like, this cannot last.
Yeah.
This is a really grey area, is definitely going to be reversed. So the fact that it then hung around for so long that it actually became a tax planning tool, it was always something I think was on the cards, and I feel that it's difficult to object to, put it that way.
Agreed.
As far as the other things in inheritance tax go, I mean, the AIM market rallied because they only get hit with 20% inheritance tax instead of 40%. So, you know, I mean, I'm sure AIM investors will be relieved about that. The farm stuff, now I know nothing about farming, to be very clear. I think that people were quite shocked about the £1 million limit. That does come on top of your own allowance law. So it is a £2 million limit rather than a £1 million limit. From what I'm led to believe from looking at Twitter, most farms are still bigger than that. But
most farms that are sustainable or profitable will be much more valuable than that. If it's not a hobby farm, it's going to be more valuable than that. So that was quite an interesting move. And I also felt that a bit like with AIM, it's one of those things, once you've broken the taboo of adding inheritance tax to those, it could go on. So I know everyone who invests in AIM is very relieved, but I wouldn't be at all surprised if there's another bite at that one.
Yeah, and I mean, to be fair, it was always daft that AIM was being propped up by being a funnel for inheritance tax avoidance because, you know, the companies should be good enough not to just be getting money because it's a way to minimise your losses. But at the same time, if you're not then going to replace that, you know, we already have an issue with raising funds for small companies in this country, or at least it's not actually, it's more the funnel between small companies and big companies. And obviously the budget didn't do anything in particular for capital markets. It wasn't against them, but it wasn't for them either, which was something that had been talked up a lot before the election. As far as other stuff goes, capital gains tax going up from 10 to 18% and 20 to 24%. Again, that was more a relief from what it could have been. Doesn't reform anything, doesn't make anything more straightforward. So in terms of complexity, I would have said that it wasn't. But then
didn't pass, didn't fail.
No Chancellor has passed that for years and years. You know, they don't ever make it less complicated. And I do think that's a problem. Is like politically speaking, if Rachel Reeves could not get fuel duty through now at the start of a 5-year term with a shallow but wide landslide victory, you know, it's never going to happen. And this is why, for example, like the OBR, there should be something in the rules that says it's not biased or making a judgment if a politician is clearly not going to have this in the next budget, for us to take it out and put the pressure on them. You know, actually, in a way, that would be a good way to take the fiscal watchdog side of things, because politics is the thing that gets in the way of improving the structure of our tax system. And if we want to get more productive, then we're going to have to simplify it. And simplifying it doesn't mean making the tax take lower. It actually would probably make the tax take higher. But there are so many things that have been done over the years because they don't show up on working people's pay slips. You know, even though actually it probably means a load of working people will get fired or not get hired as a result of this. So I think that we don't think enough about the structure of our systems in terms of, you know, the bare numbers. As long as the spreadsheet adds up, then well, we can put up with it. But you know, there's a reason that we've not had growth since 2008, and that clearly comes down to something qualitative rather than quantitative. Doesn't mean it's easy to fix, but you know, it's not like, I mean, because we blame demographics all the time, but we didn't all age overnight in 2008. There was a global financial crisis, and that did something. So either the productivity before then was artificial, which I think is partially true, but also since then we've done something to the economy that's made it much, much harder to be productive. And whether that's too much financial regulation, I'd be careful of going down that route, or if it's something else. But that's the sort of questions we need to have, and they are divorced from the
well, there was quite a lot of this kind of thing in the budget. I mean, if you look at it, I mean, and if you look at several of the tax changes that effectively, when you look at the numbers, will raise no money at all. So VAT on private schools, the changes to non-doms regulations, the abolishing of that, and the private equity, rise in private equity taxation, so 32% on carried interest. These will raise almost nothing, but if anything, but they had to be done because they were so clearly laid out in the manifesto. Is that fair?
Yes, absolutely. I mean, the choice to try and tax those with the broadest shoulders always means that you're looking at choices for people who are well advised, are savvy, can have lots of options, and so I mean, one thing is to take it as a good thing that those tax measures are not in the budget book raising massive amounts of money. It means that they've taken a realistic assessment of what people will do in the face of higher tax rates.
Yes, so there has been more of a focus on behaviour than you might have expected in the run-up to the...
Not more than I would have expected, because I spent 10 years trying to put those kind of assumptions into numbers. But there was a lot of focus on the types of taxes where behavioural responses are big. And it's good to see that, you know, they've thought about them. Whether they're right or wrong is, you know, unknowable, because there's some of these taxes where you're talking about hundreds, maybe thousands of people, not millions, as the tax base. And you know, I remember asking the HMRC officials that, you know, you can't tell me, but could you just like Google the 50 biggest and find out if their kids are, you know, school age, are they likely to move? I think this is more important than finding the right elasticity from a study of Swiss cantons.
Yeah, I suppose one thing that people would say is that there'll be relief out there because the rise in the tax on carried interest to only 32% when it was expected to go much higher proves that you can still lobby this government. And if you've got plenty of money to lobby, you can still make sure that it works for you.
And to be honest, it looks like they're kind of following the evidence. Those are the models I remember of, you know, the revenue maximising rates in HMRC's giant spreadsheet. So that's a good thing too.
Yeah, Stephanie, would you expect another round of tax raises from this government?
I mean, I think the big risk is that we've all said this is an amazing, huge budget, and there was also this kind of insane expectations around it, that it was going to kind of set the political weather for the whole of the Parliament and resolve all of the sort of disquiet on both on the Labour side and in the broader public, and solve all our economic problems. I mean, it just was never going to be able to wear that carry that weight. You've raised 40 billion. More than almost any other chancellor as a share of GDP in the modern times. You've stopped the rot in the public services, but you've chosen to inject. She has chosen to inject, front load a lot of that additional spending in the first year and a half, including for the NHS, and then for as Andy pointed out, for the unprotected departments, you're looking at a slightly less of a squeeze, I think half the squeeze in real terms every year that was the previous plans, but still much tighter than we've recently achieved. So I think that the risk is this money you know, there's an 1.5% of GDP extra going into the NHS over the next couple of years, give or take. Hopefully we will notice that, and hopefully it won't just get swallowed up because of the sheer speed of which it's going in. It won't just get swallowed up in ways that don't build lasting improvement. You know, I hope there is a sort of step change in the way that IT works. I hope they're willing to hire some more managers to actually handle this money, which is always politically difficult, but that's what they desperately need, actually, is more people to actually to manage in the NHS. And get those kind of output and productivity numbers better so that we continue to notice it. Because otherwise, you may be sort of, in a sense, squandering this big tax rise that you were able to do at the beginning of Parliament and having to go back in a couple of years. And I think they will inevitably have to come back. I think the question is that when they come back, will people say, okay, we can see this is working and we're willing to kind of spend a bit more money on it? Or are they going to say, well, hang on a minute, you know, why should we throw more money into a black hole? I mean, maybe we will then be talking about a different kind of black hole.
Yeah, I mean, here is the big risk for this government, right? So they've done this, it's a big splash, lots of new spending, and so lots of new money going into the NHS, even though they said that wasn't going to happen, it has happened. So the general public is going to really need to see a result there, and reasonably quickly. And at the same time, one of the results of the budget has been that we now expect rates to fall slightly more slowly than we might have before, and that will hit people's mortgage payments, etc. So there's a lot of risk in here for the government politically.
Yeah, I mean, obviously we shouldn't get too excited about the numbers. I think it's true that we stopped expecting a December rate cut yesterday by the time that Rachel Reeves had stopped talking. We still expect a November one. I think the difference that the OBR is suggesting, it's maybe interest rates or bank rate over the course of the next few years will be 0.2 percentage points higher, something like that. I think ordinary people may not notice a lot of this tax increase, but it certainly is quite a squeeze on business, and potentially is still not doing enough.
You said earlier, Andy, that possibly the best thing you can say for this budget is that public services are now not going to get worse. Is that really the best we can say?
I hope it's not the best we can say. I think I read all the front pages of 70 billion of extra spending. I looked at the line that shows the state roughly the same size over the next 5 years, and I just thought to myself, like, it tells you more about what could not be delivered before than it does about the generosity of what's been announced. And if you look at public services today, you know, you can name any public service and there is something equivalent to a backlog associated with it. Overcoming that, I think, is part of the reason why the spending is front-loaded. But overcoming that in 2 years for some of these things is going to be quite difficult. So possibly, yes, you know, things look quite broken in quite a lot of places right now. Like, them not being broken is probably, you know, is a good outcome, but it's probably not that kind of feel good, everything's brilliant because the public spending numbers are so generous.
Okay, I'm not really hearing massive positivity. John, was there anything in here that you think will make things better for ordinary investors? The good news is that ISAs weren't fiddled with, and we're set on our allowance there for 5 years. VCTs we get to hang on to. AIM 20%, not 40%. But for me, the big problem was no active signal of confidence in the stock market. You know, we wrote a lot, you and I and a lot of other people in the run-up to this budget about wouldn't it be great if we could see some reduction in stamp duty down perhaps to historical norms, or perhaps even an abolition of stamp duty, which would send some kind of a signal. We were very keen on the Brit ISA, which we obviously knew wasn't going to come up, but we were waiting for some kind of signal from the government that there was going to be intense support for UK stock markets, even although we slightly disapprove of it, mandatory investments in UK markets from DC pensions.
I think they could have thrown a bone, because stamp duty on shares is a good example, because it raises 3.5 billion a year, and if you could either even just reduce the rate, or you could say extend the relief up to FTSE 250 companies, and then just see if it made a difference. And if it made a difference, then take it further. You could have tested that. And I get that, you know, it's a small thing, but at the end of the day, I mean, that's again one of the slight problems I think with the way we do things here anyway, is that the Chancellor stands up and literally names schools and hospitals that they're going to individually rebuild. And you're kind of like, is that no a local councillor's job? So that kind of thing, you know, so they could have done something on that front. And I think the other problem is there's an element of, you know, they clearly decided to just go down the non-dom route they were already planning, which is absolutely fine. There's nothing. Maybe it'll pan out, maybe it won't. I mean, we will just find out if they all up and leave or if they don't. But it's more that point of signalling a continuation of the support. Basically, it's like, I think a lot of people in the city maybe voted for Labour thinking it was New Labour 2.0. Obviously, times have changed. You know, the 1990s was a different world. So it's not just that. But I think that with this budget, they've sort of confirmed it, guys, that this isn't Tony Blair again. It's not Jeremy Corbyn either, but it's something closer to your kind of big state, you know, not really kind of hugging the rich sort of mode. And I think that that isn't ideal given that we're wanting to get more investment in the UK.
Yeah. And then a lot of our listeners will be buy-to-let investors. Buy-to-let investors? Quite a lot of our listeners are buy-to-let investors. And
note that the hands only went up like that.
A little bit, yeah.
Like,
they didn't go up quite as high as they did in the last few questions I asked.
Tomatoes, we searched them before they came in the room. It's okay.
And they will be mildly disappointed with this rise in stamp duty. And I got some response on social media to talking about this last night, saying, why is this a problem? You know, buy-to-let investors already own their houses. Why do they care if stamp duty goes up? But of course, as we've written about over and over and over, stamp duty is in the end paid by the seller, not the buyer. Still, they'll see it and reduce prices when they sell. So that's going to be disappointing.
That's going to be disappointing. I mean, but to be honest, if you're still a landlord at this point, then you must really know your business because, I mean, since George Osborne, the writing has been on the wall for, I mean, I'm amazed it's survived this long, you know, because all of the tax advantages have been taken away. It's now extremely tax inefficient in lots of ways to be a landlord. And I mean, I'm not necessarily, I don't have a big issue with that in some ways because too much capital in the UK is locked up in houses. But, you know, yeah, if you are still a landlord, then, you know, I kind of salute you because you must be very good at your job to be making money at it.
There you go. Congratulations from John to the landlords in the audience. Well done. Right, we're going to move on to questions. We have 20 minutes or so. So if you do have them, now's your chance. I'll start with over here. Thank you. Just to remind you, we are recording. So your question will be recorded and so will the answers. And so you will need the mic and you'll need to speak directly into it. Thank you.
Good morning. Thank you very much, guys. Following the budget yesterday, both sort of following the commentators on Sky News, BBC, there was strong opinion raised that potentially the Labour government don't actually have a mandate to do what they've done, considering the discussion on tax rises was considerably less than what they've actually gone ahead and done. Yes, Rachel Reeves has blamed this 22 billion black hole, but I'm wondering what the three of you feel on that issue.
I mean, I think I'm going to hand that to Stephanie because she did just slightly answer it earlier in the conversation by saying that the polls do show that most people thought that taxes would go up more than had been suggested in the manifesto, regardless of who won. But I would rather agree with you that they were incredibly clear pre the election that this wasn't going to happen. And whatever excuse you use, it did happen, and it happened on steroids. But Stephanie, I'm going to disagree.
I'm going to take a risk because this is being recorded, so I might be making a mistake. But I would say I think the way you judge a election campaign is not by exactly what the debate is about, but about the sort of direction of change that people are indicating. And if you go back to 2010, and as someone who was the economics editor of the BBC at that time, I remember quite clearly that the argument over austerity was plus or minus 12 billion of austerity. Alistair Darling, the last Labour Chancellor, had put in what was considered by Labour standards to be quite an austere budget earlier in the year, and was trying to kind of fix some of the mess from the global financial crisis, fiscal mess. And George Osborne was claiming he was going to do 12 billion more of squeeze in spending. And we had a big debate about it. Of course, that turned out to be, from memory, a fifth of what he actually announced in the summer budget. So you could, but we knew that they were going to be tougher on spending, and that was the sort of the honesty in the message was not the number. It was like we will care more about fixing fiscal mess, and we will do it more by spending cuts. And I would argue, people would disagree, that this election campaign had that flavour, and I suspect the tax increases are about 5 times what they admitted to, give or take. But we sort of knew that Labour was going to be worried more about the quality of public services and didn't think tax cuts were a priority. And that was so we knew the flavour, we didn't know the numbers.
Yeah, but I suppose ordinary voters might actually listen to the numbers, and they might have actually listened when they were told that it would be, 8 billion fully costed, etc.
As I say,
it's entirely reasonable to listen to what you're
told. To the extent that it was, I think if we make a big thing about how they should now be, taken to task for having, misled the public, then we would have to go back through many, many governments who've done exactly this.
Who all did? Andy?
Prior to this election, the public spending numbers, which is the source of the problem, in my walk of life, everyone knew that they were too low by a massive amount. Some people thought 20 to 30, some people thought 50 to 60. Yesterday's number was 70, of which 20 is a decision to do more public investment. So the order of magnitude was known. The other thing that everyone in my walk of life was kind of lamenting was that no party could say that these public spending numbers can't be delivered and therefore we'll need to raise more taxes, because you open yourself up to the tax bombshell retort. And so there was what did Paul Johnson call it, a conspiracy of silence, didn't he? That this was well known, but not part of the debate.
Well known by you, Stephanie, me and John, but maybe not by the electorate.
Yeah, except for the number of times that Paul Johnson was quoted over the course of the campaign. I mean, it's true that maybe no one's watching the BBC, ITV, Channel 4 anymore, or listening to podcasts, but I think in any one of those, any economic discussion on any of those media featured the quote, or at least the thought that Andy's just given.
Yeah. Okay. So yes and no is the answer to that. Another one over here. Hang on for the microphone, please. We'll try and get the answer to this one to be less yes and no, more clear.
Thank you very much. Just a question about the sort of the politics of the budget, where it seems from what the OBR have said that in 2028, 2029, when we're likely to have an election, because of the actions in this budget, we're going to have slowing growth and rising inflation, which to me seems quite a bizarre political choice to sort of effectively front load the consumption and potentially face the country when things are getting worse.
That seems fair.
I agree with
Stephanie.
that. I mean, I think when you say bizarre politically, so I guess we can't say that this is an overly political budget, because it's possible, as Andy suggested, that it actually was a realistic and sensible strategy to be front-loading that spending, or at least to be doing more of the spending in the first couple of years, given the backlog. And I think only those who will be overseeing the way that money gets spent can know whether that's really true. But they conceivably have chosen to actually do the thing that makes most sense, as opposed to the thing that's politically savvy. But I agree with you, at the moment, there is an unusual arc to the way the spending and the sort of pain, if you like, is being felt. And I guess that's another reason for thinking that this will not be the end of it. But it never is, by the way.
Never is the end of it.
There's going to be more budgets. They have to come up with more.
Yeah, they have to come up with more stuff. And it seems unlikely that those coming budgets are going to involve falling taxes or projections of rising growth. John, you're nodding away. Did you want to add something to that?
I just think I wouldn't pay too much attention, and no offence to the OBR and and all the other think tanks and the Bank of England, because they're wrong usually, and they're wrong for a good reason, because stuff changes. It's like stuff isn't static. People react to forecasts. The entire market, the entire economy is reflexive. So I think even if at the end of the day, it's not going up by that much, and if growth is only at that level by that point, yeah, I think we will all be heartily disappointed. But yeah, I just wouldn't attach too much, especially not to 5 years out, because anything can happen.
Yeah, and models, as Andy has discussed, models can't encompass all the behaviour elements and the technological change elements, etc. So anything could happen, good or bad. Hopefully good. Others? One here in the front. There's Mike. Here he comes.
Thank you. John, I agree with you that the IHT pension loophole it's hard to argue with that being scrapped, but it is just another example of the government making changes to the pension system. And as someone who's relatively early on in his career, I'm expected to invest a lot more money up in this for another 30 years, 40 years with complete certainty. Is it time I start thinking about diverting some of that money going into my pension elsewhere into other vehicles? Or as well, like how can the government regain my trust on pensions?
Like buy-to-let, for example.
I've heard good things.
I mean, obviously, we can't give personal financial advice. One thing we've always recommended, and to be very clear, I mean, this is entirely bipartisan. Governments just, and it kind of goes back to what I was saying before. It's like we've got a structural issue that boils down to politics largely militating against good policy, and that seems to have become an even greater problem, I think, over the last 10 years or so. So this is both Tories and Labour and anyone else that will ever get in. So your pension is subject to political risk in a way that I feel, for example, your ISA isn't so much. Because an ISA is a really straightforward financial product, despite efforts to complicate it. You can take your money out of it pretty much instantly, most of the time. And also they're very popular because people do understand them. So that's one reason why governments have tended to avoid targeting them. Whereas pensions come in all shapes and sizes. It's a lovely pot of capital that's just locked up there, not doing anything. You know, it's like it could be getting used to spend on public services, etc., etc. So there's always a temptation to go after it. So basically, as a loose guide, I would sort of say, don't, you know, obviously you need to pay into your pension. If you get auto-enrollment, for example, in your workplace, then that's money that you're passing up on if you don't take advantage of it. But at the same time, you should probably be putting some money into your ISA as well. So basically, you want to diversify your savings vehicles as well as diversifying your portfolio. Does that make sort of sense?
And with John all the way on this, absolutely right. It's, there's so much political risk in your pension, much less political risk in your ISA. You know, whenever we write about this, you know, the old joke on banks, why did you rob a bank? Because that's where the money is. That's how governments feel about pensions. We have a question at the back here. Thank you.
Hi, I am a charity chief exec, which I think makes me very unusual in this room. But one of the things that I'm really interested in asking is charities have been propping up the public sector for really quite a long time now. And some of charities are obviously enormous, but most of them are small. And this hit on national insurance is going to be really, really challenging for charities. Do you have any views, or what views do you have about what the Chancellor might have been able to do for the charity sector, which does employ more than 1 million people?
Anyone got thoughts on that? No? Okay.
OBR tricks.
No, I haven't.
Okay, well,
I mean, I think it speaks to the. I think the answer is we don't, but I think that it does speak to, even when you pick a broad tax like this, and that's what we would have wanted them to do, rather than try and find billions here and there in ways that could actually be very costly for certain chunks of people. You are hitting, people in social care homes will be also facing some of the biggest squeeze from the increase in the national living wage and from the national insurance rise. Charities, there's lots of sectors that we wouldn't necessarily want to be stressed who will find this. But I guess that speaks to a sort of structural issue that those parts of the economy are being lent on too much. But no, I think it is something that's going to be difficult.
And I have a very unpopular answer for you. which is that there's an awful lot of room for consolidation in the charitable sector. There are many far too small charities all doing exactly the same thing. They're very heavily supported by the taxpayer via gift aid and via direct grants from the government. And I think it's a space of astonishing inefficiency. And if this is one of those things that drives the third sector to slightly pull itself together, I'm not sure that would be a bad thing. May not have been the answer you wanted, but it is the answer you wanted. Excellent. So you're out for consolidation. Right, we have another question here, third row, I think. Lady in the third row. That's the second row.
Okay, I'll take the
We'll come to you
third
next.
row. So is the panel arguing for the setting up of a DOGE, Department of Governmental Efficiency, US style?
Oh, more departments. I mean, this is like...
Is that the one that Elon Musk is going to run?
Yeah.
Okay, fine.
Yeah. I mean, I'm never sure about setting up any new departments to do anything else. I do remember that back in the day, there was one of the big banks that had a form you had to fill in for the applying for the creation of a new form. And so whenever I hear about the creation of a new department to help other departments do things, I worry about it slightly, but Stephanie may have
Well, actually, no, I'm interested in whether, I mean, this is a constant theme of public sector productivity. Obviously part of the challenge and having to put more and more money into public services while it remains flat, even just to keep it in the same scale, is that the challenge of getting productivity growth in public services, and we particularly found that in the NHS over the last few years. So I wondered whether are there approaches to increasing public sector productivity that seem to you more or less credible when you're looking at these plans?
I think surely the best news for everyone is that they are setting up a new institution called the Office for Value for Money, which will try to do this. Maybe I'll sound a note of optimism. Some of the addition to public investment is not private growth enhancing investment, it is public sector productivity enhancing investment. So if you look at anyone who's been into the NHS knows that the computer system is not conducive to the productivity of the people who work there. And that can only be addressed with public investment. And so putting more investment in is a way of helping that. And I think basically that kind of, you've got to invest to save or spend to raise, is where usually I think it looks more credible. The other way that public sector productivity is typically raised is just by squeezing pay.
Yeah. And it does feel that we've got to do something about public sector productivity. When anyone talks about the productivity crisis in the UK, they're not really talking about the private sector, they're talking about the public sector, because that's where the drag is. You look at those charts and you can see public sector productivity is basically flatlined for 20 years. And so we must do something. I'm not sure that's the answer, but we must do something. Right, I think we've got time for one more question, and I did say I would take this one here. Third row.
Thank you. A question really about workers and productivity. And given the government got itself into a pickle defining workers, has this budget actually been good for working people, however you define them, and specifically this great big black hole of economic inactivity that's affecting about 10 million people? And to the point about productivity, there's a considerable lag in the private sector as well. And again, has this budget done anything to improve the chances of work and working people? Doesn't appear to me that it necessarily has done.
Okay, big question, and we've got about 20 seconds. Stephanie?
Working people use public services. I mean, I think it just goes back to that fundamental point that probably this was not quite the minimum, but not close to the minimum of what was needed to just sort of to prevent public services from getting worse, as Andy suggested.
John?
You've made employing working people more expensive, so that enhances the odds of them getting replaced by robots. So on the one hand, productivity will go up. Is it good for working people? Probably not. It's my 50.
But everyone will feel better if the NHS starts working. You get your hip
definitely,
operation, you're going to feel better working or not.
Aye.
Andy, any final thoughts to add there?
If the government can achieve its aims on reforming the planning system, everyone can have more buildings and equipment to use, and productivity will
will automatically soar.
Blossom.
Excellent. Okay. On that note, at the beginning you were all absolutely miserable. Who feels better as a result of what they've heard on the podcast? There you go. Those of you who aren't here, about 10% of people feel better. So I don't know what that tells you about the podcast.
10% at a time, you know.
Yeah, there we go. We're getting there. Thank you all so much for coming today. We really enjoyed having you, and I hope you enjoyed being here. Thank you to my wonderful guests.